This is Jody Trana with Chapter 4, Part 4 of Principles of Accounting. Now that we've been through the entire accounting cycle, let's review that cycle and talk about the reports and ledgers that we use throughout the cycle. First of all, any period, except for before you start a business, any period is going to have beginning account balances. Here we see $2,200 in our accounts receivable T account. Remember that the T account also represents our general ledger accounts. The second thing that happens in our accounting cycle is that transactions occur. As those transactions happen, we post journal entries into our general journal. If we were running a manual bookkeeping system, once a day or once a week, we would post our journal entries from our general journal into our accounts. Here again, we see a T account representing our general ledger account for accounts receivable. We need to be able to keep track of the balances in our general ledger accounts. We've previously used a general ledger form that allows us to keep track of a cumulative balance in that account. If we're using T accounts, we just need to take time to calculate that account balance. At the end of a period, we are going to create a worksheet that has all of our unadjusted balances in the first column called the unadjusted trial balance. The sixth step in the process is to take a look at our unadjusted trial balance and review any activity that may be affecting revenue and expenses but had not been entered yet. These will become our adjusting journal entries. They'll first be written up in our general journal, and then they will be posted to our ledger accounts or our T accounts. We will also take those same adjusting amounts and enter them into our worksheet into the second column. Now that we have our adjusted account balances, we can prepare the adjusted trial balance. Our adjusted trial balance has balances in it that have been adjusted to give us the most accurate view of our revenue and our expenses. Now we can create our financial statements, the income statement first to identify our net income or net loss, the statement of owner's equity next because we need to have our net income balance in order to finish this statement, and then our balance sheet comes last. The reason we prepare the statement of owner's equity before the balance sheet is because our ending capital account from this statement will be used on our balance sheet in the equity area. The ninth step in the process is to write closing entries. We're going to write journal entries in our general journal that close our temporary accounts. Remember that our temporary accounts are revenue, expenses, and one capital account, the owner's withdrawals account. All of these accounts will be ultimately closed into the capital account. The final step in the accounting cycle is to prepare one more trial balance. This is the post-closing trial balance, and it will be the same at the very end of the period as the beginning of the next period. It will only have balances for permanent accounts. Those are our assets, our liabilities, and our equity. Let's review the financial statements again and understand their purpose. If Connie here wanted to know what her sales were this year, or how much her expenses were this year, or how much profit she made this year, what financial statement would she review? Connie would look at her income statement. What if she wanted to know what her total assets were at the end of the year, how much debt she had accumulated this year, or how much equity she has in the business? She would look at her balance sheet. What if Connie wanted to know how much money she individually had put into the company this year? Or how much of the profits she was able to reinvest in the company? She would look at her statement of owner's equity. Understanding these statements and knowing what they're used for will help you in preparing them. There are many financial reports. Here we have the trial balance, the income statement, statement of owner's equity, and the balance sheet. For each one of these reports, you need to understand what it shows, what the time period is for, and what accounts are on the report. The trial balance is solely to report all of the account balances of the entire company. It has a debit and a credit column, and it is the only report that has a debit and credit column. The trial balance can be completed for any point in time, and all accounts will be recorded on it. The trial balance has to balance the debits with the credits. The purpose of the income statement is to show a company's profit or loss. It is shown for a period of time, and it only includes the accounts of revenues and expenses. It does not have a debit or credit column because we are just comparing revenues against expenses. The purpose of the statement of owner's equity is to tell us what is included in the company's equity account, what makes up the equity. It is also presented for a period of time like the income statement, and it includes net income and all of the capital accounts. The purpose of the balance sheet is to show all of the assets of the company and who has rights to those assets. There are people inside the company that have rights to the assets. That's our equity. There are also people who we have obligations to that have some rights to the assets. Those are liabilities. The balance sheet is always prepared at a single point in time because it includes permanent accounts that the balances roll and change with all the activity. It includes assets, liabilities, and equity. The balance sheet must balance the assets with the liabilities and equity. Notice the only two reports on here that must balance include the word balance in the title. The balance sheet does not have a debit and credit column. On the balance sheet, we compare the total assets with the total liabilities plus owner's equity to see if those balance. Let's review the order in which we prepare these three financial statements. Using our adjusted trial balance, we start at the bottom and capture our revenue and expense accounts to determine our net income. Once we have the net income amount, we can use that in addition to our equity accounts to create our statement of owner's equity report. With the statement of owner's equity that tells us our final capital balance, we are ready to prepare the balance sheet with our assets, liabilities, and our equity account. We've been practicing two types of balance sheets. This one is the more common type of balance sheet, and it is a classified balance sheet. It classifies both the assets and the liabilities in relationship to how long we expect that asset to be there. For assets, we have current assets, which are expected to turn into cash in less than a year, and we have plant assets that are not expected to turn into cash within a year. For liabilities, we have current liabilities, which are obligations that we expect to pay within a year, and we have long-term liabilities, which are obligations we have but do not expect to pay them off within a year. There could be other classifications in other types of balance sheets, but these are the classifications that we are limiting ourselves to right now. Within these classifications, such as current assets, we will also arrange these based on their liquidity, with cash always being the most liquid, accounts receivable usually being the next most liquid. Under liabilities, we always list accounts payable first, as that's usually our largest obligation and also the obligation we pay most often, on a daily basis often. And then we list the other liabilities based on how quickly we think that they will clear. We don't rearrange them every time we do a balance sheet. We usually report them in the same order every single time, but in general, we try to show them in the order of how often we use them and how often they clear out.